What's up traders, Tom here with another video. Today we'll be discussing our thoughts on billionaire hedge fund manager Ray Dalio's recent comments about the Federal Reserve boosting stock market and other asset prices. Are capital markets ever going to become free again? Stay tuned. So today we'll be covering our thoughts on Ray Dalio's comments, as well as the non-farm payroll figures potentially being lied about again in terms of unemployment figures, and our week ahead thoughts for the S&P 500 and stock market. Here we have the growing central bank presence amid heightened uncertainty, and this is core to our discussions about Ray Dalio's comments, which will be coming soon. On this channel, we've discussed several times how the Bank of Japan has led the way in terms of central bank policies on what is capable under the monetary system. In fact, the Bank of Japan now owns over 50% of all government bonds as a share of the total outstanding amounts. On the left-hand side over here, we see an even more interesting statistic, however, and that is that we are seeing a massive increase from the Fed and the ECB, as well as the Bank of Japan, over this crisis. But look at what is being projected moving forward. So we have the Fed moving from under 20% of asset ownership to potentially upwards of around 46 to 48% asset ownership over the next couple of years. We have the ECB moving from under 40% to upwards of 60+% in terms of asset ownership. And more importantly, we see what is capable on the right-hand side here with the Bank of Japan now moving upwards of potentially 130% of GDP ownership within the central bank's asset prices. That is phenomenal, but it shows you Ray Dalio's most recent statement and why he believes that the balance sheets are set to explode over the next couple of years. So let's unpack Ray Dalio's recent statements in terms of his interview with Bloomberg on Thursday. Basically, Ray Dalio is saying that the economy and the markets are now driven by central banks in coordination with the central government. No surprises here. It is absolutely proven right now that central bank and government policies are driving stock market assets as well as other capital markets. While Ray Dalio doesn't say that this didn't need to happen, in fact, he does say it did need to happen, his big thing is that we are going to see central bank balance sheets explode, and this is going to have a scale of different consequences. Where is this money going to go? Well, he argues it's going to go into certain asset classes. And of course, one of those is going to be stock market. In fact, he believes that the investors might feel a sticker shock when they see price to earnings ratios north of 40. But that is no less implausible than zero interest rates. So he believes that things like companies like Apple, companies like Facebook, and these growth stocks could hit upwards of 40 PE just because of the central bank's monetary policies around the world. We're not going to have any traditional way necessarily of doing market valuations, is his argument. Effectively, we'll look at a company and we might say it's worth this much in the old style of doing a valuation, but that is not going to work anymore. And he famously said that cash is trash in January. And of course, his big thing is that he wants to buy stocks and he wants to buy gold. He believes that those are two very compelling investments over the next decade. So Ray Dalio's biggest, possibly most shocking statement in all of this, other than of course he believes that capital markets are not free markets anymore, is what if there was a compelling alternative to the United States dollar? What if investors piled in and purchased that dollar instead of purchasing United States dollars? That would be terrible for the United States. And what we would end up seeing is that the biggest disruptor to the US economy over any period really in history. This would force the Fed to make so many different unprecedented policy changes and would be incredibly detrimental. So that's something and a story to watch over the next decade. So Ray Dalio's comments really also come into what is the Fed going to do over time. So on Thursday last week, we saw the non-farm payrolls numbers. And on paper, they look good. It looked like everything was going okay. But Ray Dalio is basically saying we're going to see explosion in asset sheets. We already saw that in the first image that I showed you, with the expectation being that the Federal Reserve, the ECB, Bank of Japan, and other central banks won't be able to stop this printing now that they've begun. No one's been able to really stop it or pull it back, even with growth in the economy. We see that from the quantitative easing that happened during the GFC. So technically, we're seeing US claims dropping in terms of a curve over time. Since the crisis started, they've dropped over time. One of the numbers I'm really looking at, though, is actually the unemployment level in terms of permanent jobs losses. That's the one that I think is the key number. In the US, obviously, there's furlough, and furlough means it's kind of gone on halt, and the job is theoretically possibly there in the next couple of weeks. We just saw the US economy open and then close in certain states for certain industries, and I expect this number to increase over time. This is the GFC over here to the left, and we can see what happened with the unemployment numbers and how bad they really got in terms of permanent jobs losses. And this is where we're at now in this crisis. So expect this to raise, and this is the number that everyone should be looking at because it's the most important number of them all. But what about that jobs number? Was that jobs number pretty good? Well, it sounded good and everyone was talking about how great it was. But as we saw, the stock market did not move necessarily as well on the close as would be expected from such a great non-farm payrolls. So it said that unemployment rate has fallen from 11.1% down from 13+% the month before. The thing is though, if we actually break down the statement, what you'll notice is that there is this statement in the figures, and this is where the lie potentially is there. The headline unemployment rate was understated slightly due to a counting error at the Bureau of Labor Statistics. Workers who still have jobs but have not been working are being counted as employed even though they are supposed to be considered unemployed under the BLS rules. Well, that's the same miscalculation error that they had in the May report. And that is pretty worrying. In fact, I find that unbelievable that they could do it again. The other thing that in this, it says here, however, the BLS has said the discrepancy declined considerably in June, making the actual unemployment rate only about 1 percentage point higher than the reported level. So that would mean that the June unemployment should be 12.1%, not 11.1%. Well, that's pretty ridiculous. How are they able to release these figures and then tell everybody that it's all okay and everything's so great, yet they're even admitting that it's the wrong number? It seems unrealistic and it's kind of like a mystery, yeah? But this is what is actually happening. In fact, some people are actually saying that even more people are unemployed than even these numbers say. In fact, it could be upwards of 47% of American adults are kind of like half employed, half not employed right now, some people are saying. And that's pretty crazy when we're looking at the Great Depression figures to now. But more importantly, what would this mean for the Federal Reserve and the governments? Well, we've already seen they'll do anything that needs to be done in terms of fiscal policy. If they continue to do that, Ray Dalio's statements about their asset purchases is so true. Ballooning asset purchases gone completely out of control. And they'll have to try to pull the economy back into order. So we'll have to watch these numbers, and this story continues to escalate, that's for sure. So let's now just talk about what the stock market actually did off the non-farm payrolls result. Now, I've always said the stock market's smarter than people think. The price action, as in the prices on these candles, shows us the way to giving us an idea of what is really happening. So we saw that initial kind of gap up off the open in terms of the non-farm payrolls result. It hit our resistance over here at 31.50, and then it bounced down after that and after the market close. In fact, the futures ended even a little bit lower. And this is interesting because basically the initial hype wore off very quickly when people realized, hey, is this number real or is this number slightly different to what we expect? Another thing that we've discussed a few times on this channel is that we usually see an increase into the week of a public holiday. And of course, we did see so again. We saw some sell-off near the end, but actually there's statistics going around to do with holiday research results, and this one's from 2017. But what we actually see is that Independence Day often has a negative Monday connotation to it. We have the run-in during the week, and then Independence Day specifically has a pretty bad Monday on several times. So it's just an interesting kind of stat. So what's most interesting about this little sell-off here that happened is not only are people probably interpreting that non-farm payroll result and saying, hey, what happened here? But also we've seen the Federal Reserve's balance sheet again decrease. Was that number better than expected? Yeah, it was pretty good. But of course it wasn't as good as they made out. But the Federal Reserve is trying to wind back this QE. They're trying to say, okay, we might have overreacted at the start. We need these bullets long term because we're going to have to be in this for the long term. So they're trying to wind it back. And this marks the third week of actually asset negative. In fact, it's negative now $163 billion. Very interesting fact. The Fed is unwinding because they may be confident that they're very happy with where the stock market is. And they know they need this later on, as Ray Dalio often mentions. So what about the volatility index? Well, the volatility index also spiked coming into the long weekend. That shows that the market is starting to go, well, hey, what's really going on here? So what about the dollar index? Well, the dollar index also strengthened after the non-farm payrolls result. After the first sell-off, it then strengthened as people pulled out of the market. In fact, it's got a little bit of a trend line here. And in tomorrow's video, we'll talk about this. We'll talk about all of our week ahead thoughts. And we'll talk about how to bring this all together into technical analysis scenarios as well. To summarize, I think Ray Dalio is absolutely on the mark in terms of his decisions and what he's saying about the markets. The Federal Reserve have begun something they cannot stop, and this goes for all central bank policies around the world. It's going to be very difficult for them to do that, and things like gold and things like the stock market and other growth assets could be good investments over the long term. If you enjoyed today's video, why not subscribe, hit that bell, and of course, like and comment down below. See you in the next video, everybody. Have a great weekend. Bye.